Welcome to the deep dive. Today, we're taking you on a journey through the fascinating and sometimes surprising world of IRS Publication 525. Now, I know what you're thinking. Taxes. Exciting? No way. But trust me, this document is like a treasure map, leading to hidden income sources you might not even realize you have.
That's right. We're going to decode this often intimidating document and reveal the secrets of what the IRS considers income. And it's not just your regular paycheck.
Exactly. We're diving deep into actual excerpts from Publication 525 itself, and we've got real-world examples to help make it all click. Did you know barter transactions, canceled debts, and even finding a wad of cash on the street could count as income? It's wild. But don't worry, we'll also uncover some tax-free benefits that might surprise you.
We're not just throwing facts at you either. By the end of this deep dive, you'll have a solid understanding of why these rules exist, how they affect you, and even some strategies for making the most of them.
I love that. So, let's start with something we all know. Employee compensation. It turns out there's a lot more to it than just your salary. Publication 525 covers everything, from bonuses and awards to those perks your employer might throw in.
And some of those perks can have unexpected tax implications. For example, most employer-provided life insurance is tax-free, but there's a catch. The IRS puts a cap on that tax-free amount at $50,000 of coverage. Any amount your employer provides above that, well, guess what? That excess becomes taxable income.
Wait, hold on. $50,000 seems like a lot. Do most people even have that much coverage? And who figures out the taxable part? Do I have to do the math myself?
Good questions. While $50,000 is a decent amount of coverage, it's more common than you think, especially if you've been with the company for a while. As for the calculations, thankfully you don't have to break out the calculator. Your employer takes care of that and reports the taxable amount on your W-2. You'll see it included as part of your wages in Box 1, and also separately in Box 12 with code C.
Okay. That's a relief. I was already getting a tax season headache. So, employer-provided life insurance, check. What other perks should we be looking out for?
Here's one that might make you rethink your workout routine. Gym memberships. If your employer offers a membership to a gym located outside of your workplace, that benefit could be considered taxable income.
Seriously, that seems a little unfair. I mean, shouldn't encouraging healthy habits be a good thing, even if the gym isn't right at the office?
I see where you're coming from, and it does seem counterintuitive. But the IRS focuses on the convenience for the employer angle. An on-site gym is seen as a direct benefit to the company, keeping employees on-site. And maybe even more productive, an off-site gym. That's viewed as a personal perk for the employee, which is why it's treated differently for tax purposes.
Interesting. So, on-site gym, good. Off-site gym, not so good, at least from a tax perspective. Are there any perks that are always safe? I mean, I wouldn't want to have to report every cup of coffee from the break room.
Don't worry, the IRS doesn't track every little thing. Publication 525 mentions de minimis benefits, which are those small, occasional perks that employers don't have to track for tax purposes. We're talking about those free snacks in the break room, small holiday gifts, or even using the company copy machine for a personal document now and then.
That's good to know. Now let's move on to something that can feel like a real puzzle. Retirement contributions. There are so many different plans, each with its own rules and limits.
It's true. We have 401k, 403bs, 457 plans, and more, each with its own contribution limits. But did you ever wonder why those limits even exist?
Actually, now that you mention it, I never really thought about it. I just assumed it was the IRS trying to limit how much we could save.
Well, it's a bit more nuanced than that. Those contribution limits are actually designed to encourage people to save for retirement, while also preventing overly wealthy individuals from shielding too much of their income from taxes. There's a balancing act going on there.
That makes sense.
Yeah.
So, what are the limits for this year? I'm trying to max out my contributions if I can.
For 2023, the annual contribution limit for most 401k, 403b, and 457 plans is $22,500. That's actually an increase from last year, which is good news. And if you're 50 or older, you get a bonus, a catch-up contribution limit of $30,000, which helps you boost your savings as you get closer to retirement.
Okay, so those are the limits. What happens if you accidentally overcontribute? Is it a big deal?
It can be if you go over the limit, even by a little. You'll have to withdraw the excess amount. And here's where it gets tricky. You'll have to pay taxes on that excess amount twice. Once when you initially contribute it, and again when you withdraw it, that's double taxation. And it can eat into your savings.
Ouch. That's a good reminder to double check those contribution limits and make sure you're staying within the lines. Now, I've been hearing a lot about Roth contributions lately. How do those fit into the picture?
Roth contributions are indeed a hot topic, and Publication 525 highlights some new rules introduced by the Secure 2.0 Act. This act allows certain plans to offer designated Roth contributions, which can be a game changer for some savers.
Designated Roth contributions? That sounds complicated. How is that different from a regular Roth contribution?
It can be a little confusing. With a traditional Roth IRA, you contribute after-tax dollars, and then your qualified distributions in retirement are tax-free. Designated Roth contributions work a little differently. They allow you to make Roth contributions within certain employer-sponsored plans, like a 401k or 403b, giving you more options for tax-advantaged retirement savings.
So it's like having the best of both worlds. You get the convenience and potential employer match of a 401k with the tax advantages of a Roth IRA.
Exactly. It offers more flexibility and control over how your retirement savings are taxed, both now and in the future. But of course, with more options comes more decisions.
That's true. So we've covered salary, bonuses, life insurance, gym memberships, and even retirement contributions. I'm starting to feel like I'm getting a handle on this whole income thing, but Publication 525 doesn't stop there, does it? It seems like there are even more unusual sources of income lurking in the depths of this document.
You're absolutely right. Publication 525 doesn't just cover the usual suspects. It dives into some really unique situations, like the tax implications for military personnel and clergy. It's fascinating how specific these rules can get.
It's true. The IRS recognizes that certain professions have unique compensation structures, and that these deserve special consideration. Take military retirement pay, for instance. While most retirement income is taxable, the portion of military retirement pay that's related to disability pensions stemming from combat or terrorist actions is entirely tax-free.
Yeah, that makes complete sense.
Those who have served our country and suffered injuries in the line of duty deserve every bit of financial relief they can get. It seems only fair. But what about clergy members? I've always been curious about how their income is taxed, considering offerings and fees are often part of their compensation.
It's a unique situation for sure. Publication 525 clarifies that clergy members must include offerings and fees they receive for services like weddings, baptisms, and funerals in their taxable income, in addition to their regular salary. However, if those offerings are made directly to the religious institution, they're not considered taxable income for the clergy member.
So it really comes down to who receives the money, the individual or the institution. That makes sense. But there's one benefit for clergy that I find particularly interesting: the housing allowance exclusion, apparently. They can exclude a portion of their housing costs from their taxable income. Why is that?
The rationale behind this exclusion is rooted in history and the unique nature of the clergy profession. Providing housing for clergy has long been considered part of their overall compensation package, and this tax rule reflects that tradition. It also recognizes that clergy often live in or near their place of worship, making their housing situation integral to their work.
That's a significant benefit. It really highlights how Publication 525 delves into the specific circumstances of different professions. But now I'm even more curious about those hidden income sources you mentioned earlier. The ones that people might not even realize count as income.
Ah, yes. Those are the real gems, and they're often lurking right under our noses. For instance, let's talk about bartering. Trading goods or services without exchanging money. Many people engage in bartering without realizing it could have tax implications.
Wait, really? Like,
Yeah.
if I bake cookies for my neighbor and she helps me with my garden, the IRS wants a cut of that. Seems a little extreme.
I know, it sounds strange,
Yeah.
but the IRS views bartering as an exchange of property or services, and the fair market value of what you receive is considered taxable income. Think of it this way. If you were paid in cash for those cookies, you'd certainly report that income. Bartering is essentially the same thing, just with a different form of payment.
Okay, I see your point. But how do you even determine the fair market value of something like a batch of cookies or an afternoon of gardening? Does it get really complicated?
It can be tricky, but the IRS is generally reasonable if both parties agree on a value beforehand. And it's documented. The IRS will usually accept it as that fair market value unless there's evidence to the contrary. And remember, if you engage in bartering transactions that are significant, you might receive a Form 1099-B. This form outlines the value of the goods, services, or credits you received during the year.
Form 1099-B. It seems like a lot of paperwork for a simple barter transaction. Are there any other surprising income sources we should be aware of?
Oh, there are quite a few. Another one that often catches people by surprise is canceled debt. Believe it or not, the IRS considers this a form of income.
Canceled debt is income. How does that even make sense? I thought getting rid of debt was a good thing.
It is, but the IRS views it from a different perspective. When a debt is canceled, you've essentially received a financial benefit. You no longer have to repay that amount, which frees up your finances. Imagine if someone just handed you a wad of cash equal to the amount of debt that was canceled. You'd definitely consider that income.
Right. I suppose so. But isn't there a difference between receiving actual money and simply not having to pay a debt anymore?
It's a subtle distinction, I'll admit. But the IRS sees it as a form of financial gain. The publication even gives the example of a discounted mortgage. If you refinance your mortgage and the lender agrees to reduce your principal balance, that reduction is considered canceled debt, and you'll have to report it as income.
Wow. So even trying to be financially responsible by paying down your mortgage can have unexpected tax consequences. I'm starting to think the IRS has a way of finding income in the most unlikely places.
They certainly do. And here's one that might seem even more unbelievable. Even finding property can be considered taxable income.
Hold on, are you serious? If I find a $20 bill on the sidewalk, I have to report that to the IRS? That seems ridiculous.
While it's unlikely the IRS will come after you for a $20 bill, the logic behind it is that found property represents an unexpected financial gain. Just like any other form of income, it needs to be accounted for. This is more likely to come into play when dealing with larger sums of money or valuable items. Imagine finding a rare antique or a lost treasure chest. Those are situations where the IRS would definitely take notice.
Okay, I guess I can see their point with something like a treasure chest, but still. It's amazing how Publication 525 uncovers these hidden income streams that we encounter in everyday life. It's like a crash course in the unexpected ways we can make and be taxed on. Money.
It really is. And we've only scratched the surface of what Publication 525 covers. But we've highlighted some of the most intriguing and unexpected aspects of income, according to the IRS.
It's been an eye-opening journey so far. But before we wrap things up, I'm curious about something. We talked about how found property can be taxable. But what if, instead of keeping that found property, you donate it to charity? Would that change the tax implications? I mean, it seems like a good deed should be rewarded.
Right.
That's a great question. And it highlights the interconnectedness of various tax rules. Donating found property to charity could indeed change the tax implications.
Okay, I'm all ears. How would that work?
Well, if you donate found property to a qualified charity, you might be able to claim a charitable deduction on your tax return. This deduction could potentially offset the income you'd otherwise have to report from the found property. It's a win-win. You're supporting a good cause and potentially reducing your tax liability.
That sounds like a much better outcome than just paying taxes on something you found. But are there any specific rules or limitations when it comes to donating found property? There are always rules. Right. To claim the deduction, you'll need to meet certain requirements. For example, you generally need to itemize your deductions instead of taking the standard deduction. And the amount you can deduct is usually limited to a percentage of your adjusted gross income.
So it's not as simple as just dropping off a box of found items at the nearest thrift store and calling it a day. There's some strategy involved.
Exactly. It's always a good idea to consult with a tax professional to make sure you're following the rules and maximizing your deductions.
Solid advice. It seems like every time we peel back a layer of Publication 525, we uncover even more intriguing details and potential strategies.
It's like a treasure hunt. But instead of gold, we're finding valuable knowledge. And that knowledge can empower you to make informed financial decisions, not just during tax season, but throughout the year.
Well said. A huge thank you to our expert for guiding us through the twists and turns of IRS Publication 525. And to our amazing listeners, thanks for joining us on this deep dive. We hope you've gained some valuable insights and maybe even a newfound appreciation for the complexities. And yes, even the intrigue of the tax code.
Remember, understanding your tax obligations doesn't have to be a chore. With a little bit of knowledge and the right guidance, you can navigate the system with confidence and maybe even find some opportunities to save money along the way.
Until next time, stay curious and keep those brains buzzing.